The United Kingdom's housing market has always been a subject of intense curiosity, debate, and speculation. For generations, property ownership has represented more than just a financial decision. It has symbolized security, pride, and stability. But in 2025, something feels different. Across the country, from London's towering skyline to the quieter suburbs of the Midlands and the North, there's a new and growing conversation. Headlines are beginning to sound warnings. Analysts are raising concerns, and homeowners are becoming increasingly uneasy. Buyers are stepping back, sellers are quietly cutting their prices, and many economists are asking the same uncomfortable question. Is the UK heading toward a housing market crash? Today, we are diving deep into the most talked about trends, the biggest warning signs, and the most important developments shaping the UK property landscape right now. This is not about fear-mongering. It's about understanding the realities behind the numbers, the patterns behind the headlines, and what all this could mean for you. So let's begin with a story that has captured national attention. This July, Rightmove reported a 1.2% drop in average asking prices, the steepest decline ever recorded for the month of July. Now, 1.2% might not sound dramatic at first, but July is normally a strong month for the housing market. Families often move before the new school year. Buyers tend to be more active, and the market typically enjoys a seasonal boost. So when prices fall in a month where they historically rise, it signals something deeper. Sellers are cutting their prices to chase fewer buyers. Competition among sellers is increasing, and in some places, especially in London, price reductions are becoming more dramatic. Properties once listed confidently are now quietly being adjusted downward. And this, more than anything, points to a market under growing pressure. A major factor behind today's situation can be traced back 3 years, when millions of homeowners locked in the cheapest mortgage rates the UK has ever seen. Some were paying rates as low as 1.2%. It felt like a golden age of borrowing, low interest rates, affordable repayments, and a booming housing market. But those ultra-cheap fixed deals are now expiring, and homeowners are waking up to a very different reality. Many are seeing their mortgage payments double. Others are seeing them triple. A family paying £1,100 a month could now be facing payments of £2,500 or even £3,000. This sudden financial shock has created a new group of people known as mortgage prisoners. These are homeowners who cannot remortgage because affordability checks are too strict, cannot sell because prices are softening, and cannot rent out their homes because rental income can no longer cover rising mortgage costs. This pressure is building beneath the surface of the market, and it is one of the strongest forces pushing the UK toward potential instability. Another major headline dominating conversations is the impact of stamp duty policy. For a period, temporary stamp duty cuts boosted buying activity. People rushed to buy homes before the discounts expired. But the moment those incentives ended in April, the market slowed sharply. Inquiries dropped, sales stalled, viewings decreased. According to national surveys, around 20% of property experts expect prices to continue falling over the next few months. Many argue that stamp duty adjustments helped inflate prices unnaturally, and when the support vanished, the market was left exposed. It wasn't just a slowdown, it was a shock to a system already showing signs of strain. Nationwide, one of the UK's biggest mortgage lenders, recently reported a 0.8% fall in house prices in June, its sharpest monthly drop in 2 years. Again, 0.8% might seem small, but in a slow-moving asset like property, that kind of monthly decline can add up quickly. If that pattern continued for a year, it would amount to almost a 10% annual drop. This isn't prediction, but it is a reminder of how quickly a price correction can escalate once it begins. Nationwide emphasized that affordability remains a core issue. House prices have risen far faster than wages, and with borrowing now much more expensive, many buyers simply can't keep up. When affordability breaks down, the market must adjust. One of the most surprising developments is unfolding at the top end of the market. Properties worth £500,000, £1 million, or more are experiencing a sudden slowdown. Rumors surrounding possible budget changes have created a cloud of uncertainty. Some analysts predict a major shakeup, potential new taxes on high-value properties, changes to capital gains rules, or even the replacement of stamp duty entirely. Whether these rumors turn out to be true or not almost doesn't matter. The uncertainty itself is enough to freeze activity. Wealthier buyers are waiting instead of buying. Sellers are hesitating. Estate agents say the luxury property market has sharply cooled. This matters because the top end usually drives confidence throughout the entire market. When the top slows, the rest often follows. Of course, the biggest question people are asking now is this: could the UK experience a 10% to 15% price correction in 2025? Some analysts say yes. Why? Because three powerful forces are pushing in the same direction. First, mortgage rates remain high. Even with small reductions, they are nowhere near the level seen a few years ago. Second, buyer demand has weakened. People are cautious, uncertain about inflation, jobs, and political changes. And third, supply is rising. More properties are coming onto the market, and when supply increases while demand falls, prices almost always decline. This doesn't guarantee a crash, but it does strongly suggest a correction. There is also a major psychological shift happening. For decades, the UK housing market was powered by widespread belief. Property always goes up. But today, that belief is weakening. When people see headlines about falling prices, when they watch their neighbors reduce asking prices, when buyers pull out of deals, confidence begins to slip. And confidence is one of the strongest forces in any housing market. Surveyors now describe buyer sentiment as fragile, not collapsing, but highly sensitive. A small rate increase can scare off buyers. A small negative headline can stall demand. This fragility is one of the most important warning signs of all. Interestingly, not every part of the UK is experiencing the same level of slowdown. Some regions, especially areas with strong job markets or major universities, are holding up well. Affordable towns are still attracting buyers, and places benefiting from new transport projects are showing resilience. But expensive areas, particularly in London and commuter belts, are feeling the pressure. The most expensive postcodes, which once grew the fastest, are now slowing the most. Meanwhile, some regions in the North and Midland continue to show modest growth, reminding us that the UK housing market is far from uniform. The rental market, usually a safe haven for investors, is also under pressure. Higher mortgage rates mean many landlords are seeing their costs rise sharply, but rents cannot rise fast enough to match these new costs. This has created a chain reaction. Landlords are selling up in significant numbers, new rental listings are shrinking, tenant demand is rising, and rents are climbing, yet landlord finances are worsening. The exit of landlords from the market is pushing more homes for sale, increasing supply at a time when demand is weakening, adding yet another layer of downward pressure on prices. So where does all this leave us? Based on today's trends, 2025 is shaping up to be a transitional year for UK property. Not necessarily a crash year, but certainly not a boom year either. In the short term, over the next 3 to 6 months, prices are likely to soften further. Buyers will gain negotiation power. Sellers will have to be more realistic, and discounts will become more common. Over the medium term, 6 to 12 months, a national price correction of 5% to 10% is possible, with higher declines in expensive areas. Over the long term, the UK housing market is still fundamentally strong. Demand will eventually return. Supply shortages will always support prices. But the era of extraordinary growth, double-digit increases year after year, is likely over. The UK housing market is entering a new chapter. For the first time in many years, the forces shaping property prices have shifted. We've moved from unlimited borrowing to strict affordability, from guaranteed gains to cautious realism, from rising prices to market uncertainty. Whether you're a buyer, a seller, a landlord, or an investor, understanding these emerging trends is essential. The headlines may be dramatic, and the predictions may be bold, but with clear, accurate information, you can navigate the market with confidence. The next few months will be critical. The decisions made by policymakers, lenders, and buyers will shape the direction of UK property for years to come. And what happens next will determine whether this is just a cooling phase or the early stages of something much bigger. Stay informed, stay prepared, and stay ahead of the market.